3, 2, 1. What's up, Jerry?
All
back
right.
in the studio.
Back in the studio. Bro,
Welcome back to cold-ass West Virginia.
West Virginia, it's cold there, too.
Northern Virginia.
It is cold here.
Freaking freezing.
Yeah.
I don't like it.
I don't either.
All right. Now that we started off with the positive, on a positive note.
Positive note. That's good because there's a whole lot of negative going on in the market this week and last week. And holy moly.
You going to tell us what's going on?
We're going to get to that.
Pop out your crystal ball.
No. There will be no crystal ball popping. No way. I'm not touching that with a 10-foot pole.
All right. Let's get into it, man.
All right. So, TSP Weekly Update Show, 30 January 2022. So, first thing we're going to talk about is an update to the mutual fund window. The Federal Register has come out, so we have an opportunity to comment on the rules for the mutual fund window. The comment window is actually open for the next 58 days. It's sometime in March, so we got about a little less than 2 months to add our comments, and I got we're going to go through some of the highlights of the Federal Register, and then I got the point of contact for how you make comments. Then we're going to talk about, okay, I'm still in the stock funds, but getting nervous. What should I do? We're not going to answer that question, what you should do individually, but we're going to kind of talk through why you're still in the stock funds and do you have a plan, and then some things to think about what to do. Then the bonus chart is going to be the S&P 500, the C fund. It's an example of what we do on the members only side in the newsletters and the monthly members only calls, but it'll give you guys a sense if you want to join the members only side. Kind of an example of the in-depth analysis of the C fund that we do.
Deep dive.
And then the 2-year weekly charts. Okay.
Here comes the fun part.
Yeah. If your eyes roll in the back of your head, it is what it is. I'm going to try to go through this kind of quick and just kind of highlight the really important parts of this thing.
And there's no other way for us to do this than to put the words up there, mostly because, we want people to see what it says. And you really should go in and dig into, and a lot of people may not even know this, even if you do work for the Gov or in the military, but a lot of these rule changes, most if not all, rule changes like this, have to be published, and so they use the Federal Register to do that. And what that allows for is comments, right? And for us out here,
the people that are going to be affected by the rule,
and it may not, the group of people affected may be small. In this case, it's 6 million, and I guarantee you, 6 million people don't know right now that this is out on the Federal Register, and this is your chance to read through it and comment. And so, for the millions of people that watch this show,
if we could all comment, maybe the noon rule would go away. Maybe. Wouldn't that be awesome?
Yeah, I don't even care. I wouldn't even, that would be a phenomenal. But all seriousness, though, go read through this and put comments in there.
Yep.
That's what this is for. That's why they have to do it.
Yeah.
All right, let's get into it.
Okay. So the link, I said my pen was working. I checked the batteries, all that. All right. The link is right here, okay? So for the next several slides, the link is at the bottom, so definitely check it out. That's the link. So the summary, okay, Federal Retiree Thrift Investment Board, FRTIB, making the mutual fund window available sometime in the summer of 22. This paper here that they're put up in the register, proposing a fee designed to guarantee the availability of mutual fund window will not directly increase the share of TSP administrative expenses borne by participants who choose not to use the window. Okay, so that's telling you that those of us who do use the window are going to pay for it. The board is also proposing rules and procedures to govern fund transfers to and from the mutual fund window. So those are two of the biggest highlights that we talked about. Whatever the last time we talked about this thing, how is it going to get paid for, and what are the rule restrictions going to be?
Yep.
So now we're going to get to look at both those things in detail, right? Okay. So if you don't know, if you have no idea what we're talking about, the mutual fund window, it's a self-directed brokerage account within the TSP, right? It gives you the ability to buy shares of a mutual fund through a broker-dealer that has been selected by the retirement plan, in our case TSP. Unlike the plan's core funds, the investments available through a brokerage account are not ordinarily vetted by a plan fiduciary to determine whether they are prudent investments.
Okay, let's break that down.
Yeah.
Because we always talk about, I tend to use the language brokerage account versus retirement account. And I do that because it just kind of keeps it clean and simple.
Yep.
But that's not entirely true, right? In my Fidelity IRA, right, that's a brokerage account. Right, I'm using a brokerage account to make it, but it's in a retirement account.
Yes.
So
you don't have the tax implications that you would have outside of a retirement.
It's really about the tax implications. So when you hear us, or particularly me specifically, say, we're not talking about a brokerage account. We're talking about what I'm really talking about is an account that it's non-retirement. Right. And so those have I wouldn't say massive. Depends on who you are. They have tax implications, and you absolutely should understand what that means, because it can just eat away at all your returns. You can make massive returns, but because you were in and out all year, you racked up all these fees. Anyway, so what they are doing with this window is taking within our retirement account, our TSP, they're creating another account. Right. I kind of think of it as, right now you've really got two kinds of TSPs. You got military and you got civilian. And a lot of us, myself included for a while, had both. And then I merged them. Right. And then so here you potentially could have, you might be able to have four.
Yeah.
So it's account within an account.
Yep.
And once you leave the TSP part and go into this window, the rules have changed.
Right.
And they don't affect that other side quite the same. They're connected. They're connected. Different. We'll get into that.
Yep, we'll get into that. Yep. So, but the one of the big takeaways from this particular thing is, I think what leads us to some of the rules is that not ordinarily vetted by a plan fiduciary to determine whether or not the investments are prudent.
So this is about that's a financiary language to say, we're protecting you from yourself.
It's the TSP covering their ass, basically saying that, hey, we're going to give you access to 5,000 mutual funds. We're not vetting all those funds, right? We vetted the CSI, F,
you have
G.
to understand the risk.
Yeah, the risk is on you.
And that's okay. Like that's
sure.
But that's why a lot of times, people ask, well, why can't I do this or this or this? 90% of the time, the answer is they're trying to protect you from yourself.
Yes.
The whole industry is built since, the beginning of it to protect the retail investor, because we're not educated. That's why there's a difference between all the investor types, right? And so accredited investors or rich people, either one, educated or rich. That's how you make it there. Yeah. Prove you're educated enough, being your registered investment advisor, or whatever, or have enough money. Yep. You are allowed access to things that other people aren't.
Right. Pre-IPOs.
Yeah.
Like if you want to invest in a high rise that's going up in Manhattan, you can invest in that, right? Yep. And you'll get a piece of the revenue from that. But if you're not an accredited investor, you can't access it.
Yeah, well, we're actually accredited investors, but that's different. Yeah, that's different. That's education, not wealth.
Right. Yeah. Right.
You can get there both ways.
Yeah.
Right.
You can
get there both ways. But and actually, that's actually, I don't want to skip past that, because there are plenty of people who work in the government. I don't know too many people that work in the military that might meet this, unless they're probably general level, that have an income or net worth, right? That might meet that, right? Those thresholds. So if you are getting educated and understanding how to do all these things, there may be opportunities for you out there if you meet that threshold and you don't even know it, right? And so I just want to point that out, because it's not a high threshold. You just have to prove you have a certain net worth, that you understand. The rules are crazy, but
anyway.
Let's get back to the mutual fund window.
So
it's an educational podcast.
That's it. That's what it is. That's what it is. So again, this idea of the government doesn't want to be on the hook for funds that, whether or not they're proven investments, and we'll take a look at why some of the restrictions are probably based on that. Okay, fees and expenses. So participants who choose to invest through the mutual fund window will incur Fees and expenses that do not apply to participants who invest only in the core funds. So they fall into basically 4 categories. So if you choose to use the mutual fund window, you pay a $95 a year annual maintenance fee, right? Then you pay $28.75 every time you buy or sell within the mutual fund window. Okay. Then number 3 is the fees and expenses imposed specifically by the mutual funds themselves that you choose to invest in. So what does that mean? The fees that we were talking about already, the $95 and the $28.75, those are fees that I don't know this for 100%, but I assume those are going to Alight, right? Alight's the contractor that gives us access to the window. Alight isn't a financial services company; it's an HR company. So they're not using your money to make money, right? BlackRock, the way that they do the core funds, completely different thing. BlackRock makes money.
Yeah.
That's why we don't have to pay.
This is really for administrative expense.
Yeah, that's all it is.
Yeah, and that's reasonable.
Sure.
Yeah. I mean, people hate fees, but you don't realize that there's actually somewhere in there it costs money to do these things.
Oh, 100%.
So
I mean, I can't remember. We put up before what the contract was for Alight. It was like 10 to 30 million, something like that, over so many years. So yeah, they're going to get paid, and it's going to get paid by the people that want to participate in the window.
Yeah. But so these fees, I would generally categorize those, the $95 and the $28.75, as administrative fees, right?
Yes.
This third one, and correct me if I'm wrong, I know we're getting ready to dive into this one. This one is a whole host of different fees that potentially could be in a mutual fund. Some mutual funds have their own. Well, every mutual fund has its own rules, right? Maybe it has a minimum of $3,000 or $10,000, some of them, to even buy in. And so the point is, each mutual fund has its own rules. And so if that mutual fund has associated fees within it,
you pay them too.
You got to know that, right? You got to do your due diligence and look into it to go, okay, this means that I'm probably not going to have as much flexibility as I wanted. There's usually a reason why there's a limit or there's something.
So mutual funds are designed, they're not like ETFs. Mutual funds are designed to keep people in the fund.
They're long-term investments. Right.
They're supposed to be. That's how they're designed.
Yep.
So they sort of force you to stay in there by making you put in like a $3,000 minimum.
Right.
Right. And charge you fees on both ends, and have, if it's an actively managed fund, the fees could be, up to 2%.
Right, because you got to pay that person that's actively managing it, and those are usually performing well. Not always, but usually there's a reason why they're actively managed. We talk about active management all the time. What we're trying to do is educate people to actively manage it themselves, and then you get the fee, right? Because you're actively managing it. But mutual funds, we have to remember, like Jerry pointed out, we don't know yet, although it's looking like we don't know yet whether we're going to have access to ETFs in this mutual fund window. Because even though they call it a mutual fund window, if you go look at some 401ks or other retirement corporate retirement plans, they do have in that window, it gives them access to ETFs.
They do.
We don't know. It sounds like that's not going to be the case, but there's 5,000, so who knows? We don't know.
We don't know, and it definitely sounds like it's only going to be mutual funds.
Yeah, it looks like where they're leaning toward. Why? Lowers risk in their mind, right? Lowers risk. If you start giving access to ETFs in there, we'll get into all this. But I think the key thing is as people start to educate themselves about whether they even want to participate in this, and I know we're going to talk about that towards the end, but you really have to get educated on mutual funds. So we always complain about the 2 moves a month, right? A lot of that has to do with keeping people from day trading, right? And trying to it's because people tend to lose a lot of money in day trading too, right? You hear all these great stories about people making money. Trust me, a lot of people lose money. And it's about managing risk, right, from their perspective. Mutual funds are built specifically for that reason, meaning normally you're going into a mutual fund for definitely more than a year, right? Most people don't want to take, because a lot of times we're talking about tax implications, so they want to take the capital gains. So 2 moves a month. That we might be talking about 2 moves a year, depending on the mutual fund you choose.
Yeah, it depends.
Yeah.
Mutual funds, the biggest distinction, I think, between mutual funds and ETFs is that ETFs you can trade within the day. Mutual funds, kind of like our TSP funds, only have a closing day price. So if you're looking at a chart of a mutual fund, you can't do candlesticks on a daily basis. You can do it on a weekly basis.
Yeah, and that's a bigger difference. Even though we can only trade on the closing price, we get to at least see the daily ups and downs.
Because we look at the S&P 500 as a proxy for the C fund, right?
But you can't do that with mutual fund at all.
No, not at all.
Unless it happens to be a mutual fund that tracks the S&P 500 or something.
Sure.
Right. Now, that could be the case, but there's and there are some of those. But why would you do that?
You could just buy the index.
Or you could buy the index, or you could just buy the C fund.
Or you just stay in the C fund, right?
Yeah.
We're gonna talk through all that. And so the fourth one, a fee designed to guarantee that the availability of the mutual fund window will not indirectly increase the share of TSP administrative expenses borne by participants who choose not to use the mutual fund window. Okay. So if you don't use the mutual fund window, the fee structure of the core funds has been very low, right? That fee would increase with a decreasing number of people only using the core funds, right? So to offset that, they're charging people who use the window. It's going to be, it doesn't say it here. It says it, I think, later it definitely says it in the Federal Register somewhere. It's $55 a year that they're going to go back and reevaluate every 3 years based on, what they think the...
Well, the original price came from what they think the fees will be, and going forward, they'll go back and look and see what it was and adjust it accordingly.
Right.
So if they underestimated, they're going to raise it. If they overestimated, they'll lower it. It's going to be. But the takeaway is, every 3 years they're going to change it.
Yeah, that fee.
Yeah, so it might be 50, ish now, but it could be 100.
Sure.
It could be 25. Who knows?
Whatever.
Yeah.
So at the end of the day, you got 95 plus the 55. So you got 150 a year in fees to begin with. Then you get $28.75. So if I buy a mutual fund, it costs me $28.75. If I sell that mutual fund, it costs me $28.75. Now, we're going to get into a couple of different interesting rules, but I don't want to forget this part. The $28.75 in the rule structure, we're going to get to it. But in the rule, and I know, again, I just don't want to forget, so I'm going to throw it out. In the rule structure, it doesn't say if you're in the window, can you buy and sell within the window? Is there an IFT? Because it's not an IFT. Once you're outside of the core, it's not an interfund transfer. You've transferred your money into the window.
Right.
And now what you do in the window, it doesn't say in there that you can only do 2 moves a month.
Right. They keep that, so it's implied. I read it as it's implied that you can do as many moves as you want in the window.
Yeah.
But they do count it as an IFT, and it's in the language later.
Yep.
I know we're going to show that it's counted as an IFT when I move in the window.
From the core into the window. Right.
And the other way.
Yes.
So if I say, okay, I'm going all cash, I want to go to G, right, whatever. I want out of the market, something like that. And I want my mutual fund window out also. Now I have to move it, and I know we're getting into this, but again, we don't want to miss these little pieces. I have to move it from. Let's say I've got my money distributed in 2 mutual funds. I take those and I put them into what they're calling a money market account, which is any other account. That's what we would have. It's our cash account. We got to move it there. Then I have to move it from there back into the TSP core funds. That's counted as an IFT.
That one move.
That one.
So
not the one inside.
Not the one inside, right.
The one getting out. Right. So it's important to realize, you can't get in and out of the mutual fund window all the time. It's counted as moves.
Right.
So once you're in that window,
you stay in the window.
Yeah, and it sounds like it's implied that you can move as much as you want in that window, right. And you just got to understand the fees that you may pay.
You're paying $29 every time you move within that window.
Yeah, which is, that would sound normal.
Yeah.
And that's okay.
Well, pre Robinhood, it was normal.
Yeah,
right?
Yeah. Exactly.
I mean, it's not anymore, but yeah.
Right. Most people, we can get on it. There's a whole lot to cover.
Yeah. Okay. So this is a carry on from the last sentence. So the scope of the proposed rule includes only the latter category of fees and expenses, which is the $55 one we were talking about. So therefore, the board's proposing to collect annual fee $55 from the mutual fund window users to guarantee that the availability of mutual fund window does not indirectly increase the share of TSP administrative expenses borne by those who don't want to use the window. And that's it. That's the bottom line of all that. Okay. So now to the other part of so that's the fees. And we started talking about some of this, but the minimum and maximum fund transfers. So mutual fund window allows access to funds that are not as diversified as the TSP core funds and therefore may expose participants to greater market risk. So again, they're leading you up to why they're making these rules. The mutual fund window is intended for TSP participants who are experienced investors. It is not suitable for all TSP participants. While there may be legitimate reasons for a participant to invest in undiversified funds, such needs can be met through limited portfolio allocations. So they're telling you what your investment methodology should be with that sentence. It annoys me to no end. I cannot begin to tell you how much that sentence pisses me off. While there may be legitimate reasons.
Just tell it like it is, Jerry.
Hey,
this pisses me off.
I'm telling you, it does. And that might be one of my comments. I'm like, who do you people think you are to tell me what my investment philosophy should be?
Right.
I mean, the mutual fund window is intended for TSP participants who are experienced investors. It's not suitable. That's fine. While there may be legitimate reasons for a participant to invest in undiversified funds, yeah, maybe those are the ones that go up. Such funds need to be met with limited portfolio allocations.
That was an addition to the language.
Yeah. So because of the increased risk, so they say, associated with the breadth of options offered through the mutual fund window, the board is proposing several restrictions on transfers and allocations between the TSP core funds and the mutual fund window.
We could spend a half hour on this slide, but let's just keep going.
Yeah. Okay, so here are the restrictions. TSP is proposing to require an initial fund transfer of at least $10,000 to the mutual fund window. Okay, so you can't put in less than $10,000. The second, that's the first restriction. The second, and this is ridiculous. It took me a minute to figure this out. The second restriction is this initial investment may not cause the portion of the participant's TSP balance that is invested through the mutual fund window to exceed 25% of the participant's total TSP balance. So 25%, if $10,000 can't exceed 25% of your total, what does that mean? It means your total is $40,000, right? So you have to have $40,000, and then you can put $10,000 into the mutual fund window. That's it. Why it has to be so wordy and all that, I have no idea.
Because it's the government, man. We lived it for 30 years.
Right. Of course, I have an idea.
Come on, you know why.
These two restrictions taken together would require a participant to have a minimum TSP balance of $40,000 before becoming eligible to invest through the mutual fund window. Okay, great. Third, subsequent transfers to the mutual fund window would be limited to amounts that do not cause the portion of the participant's TSP balance that is invested through the mutual fund window to exceed 25% of their total balance. All right, I'm gonna give sort of what I think this means. Subsequent transfers to the mutual fund window. So basically, let's call it new money that you take out of your core TSP account and add to the window. So that new money that you put in would be limited to amounts that do not cause the portion of your TSP balance that's invested into the window to exceed 25% of the total TSP balance. So it doesn't restrict, from my read of it, it doesn't restrict the growth that you could have in the window. Let's say you have $100,000 in TSP, and you put 25% of it into the window. So now you have $25,000 in the window, right? If that $25,000, you pick really good mutual funds, and it doubles in a year, right? And let's say so you started with 100,000, you put 25,000 in the mutual fund window, and let's say the 75 that you left in TSP, you just left it in the G fund. Okay, so let's just say it stays flat
for the sake of simplicity.
Yeah, So that 75 stays flat. The 25,000 that you put in the window, if it grows to 50,000,
which we would hope it would. The whole point is we're getting in there to make it grow faster.
Gains, right.
Yeah.
So now you have 50,000 in the window and 75,000 in your core. You can't take, from my read of this, you can't take more from the core and put it into the window because you already have more than 25% of your total in the window. So it's not like they're putting restrictions on how much you can make in the window.
You just can't put any more in there.
You can't put any more in there.
You're already at your cap.
Until you're below that 25% of the total.
Yeah.
So.
And I don't know, I mean, we'll know in a couple of years as we do this, but like, what would be the reasons why I'd move? Let's say I put my 25% in there, and we're going to call it $25,000. And, I do well that year, and I don't know, I get 20% on my money, and I've got, it's over 25,000. Yep. And I say to myself, okay, depending on how the market's going, like say it is now, I pull some off the table, and I pull it back into the core funds, and now I'm back at 25% or below, whatever, right? Somehow I got back down to below the cap. That would be the only time I could actually move some back over there. Yep. But, what they're doing is kind of putting us in a position where, and this is what we would normally do in like a Fidelity account or whatever, like an IRA, where let's say the market is tanking, and using our methodology, we want to be in the TSP, we say G fund, but in the rest of the world, we say in cash.
Money market cash.
So I would pull out of whatever, market investments I was in, and I'd pull that into cash, right? My money market account. And they give you that ability within the window. Yep. So you wouldn't have to leave the window to do that. Right. So I kind of like that. Now, the caveat to that is that money market account is not going to do as well as the G fund.
No.
That's why we love the G fund. Everybody wants to bang on the G fund, but I tell you what, I'm loving it right now.
G fund's pretty awesome.
Right? I like the G fund. I love it better than my money market account. Right, my money market account is not making the money that my G fund is, right. So that's why we like it. But I like the fact that they gave us that same capability, right. So we didn't have to like pull all the way out to the G fund. Right. We can just pull into the money market account. But to your point, sounds like we can grow as much as we want, pun intended.
Right.
We can grow as much as we want
within the window,
and that should be what we're, I don't like the 25% rule. I don't like rules, period, but I don't like the fact that if I had $1 million,
yep,
and you're only going to let me put 250,000 in there, yep, right? I could understand 50%, but
I can't understand 50 any more than 25. I dislike the rules more than you do. I mean,
exactly. All right, let's keep digging in here because it's good stuff. This is good stuff.
Okay. So there's a couple of different kinds of transfers. An elected transfer. A participant may elect to transfer money. It's only in whole dollar increments to the TSP core funds, from the TSP core funds to a mutual fund window account. Amounts transferred to the participant's mutual fund window account will initially be invested in the money market, and then participant may choose among the mutual funds offered. A participant cannot make contributions directly to a mutual fund account. I don't know why that's even there. It's pointless. Obviously, you have to go from your core TSP into the window. All contributions must first be invested in the TSP core funds. Similarly, a participant cannot receive a withdrawal directly from the mutual fund window account. So when you're withdrawing, you can't withdraw from the mutual fund window. You have to pull that money out of the window, back into the core funds, then out from there. A participant who wishes to make a withdrawal election that exceeds the amount of their balance that is invested in the TSP core funds must first transfer money in whole dollar increments from the window back to the core TSP. That's an elected transfer. There's also a thing that's called a
forced transfer.
Yeah. And it's not. It wasn't worth doing a slide about it, but
no, it's because it's for those one-offs of like you have a court order,
right,
that says you get divorced and you have a court order, or something that's something that is forcing them to do something in your TSP account, like when the IRS forces the federal government to take out more taxes. Right. It's the same thing.
Right. So if that
fall
happens,
into that,
if you're in that category, basically what it's saying is, if you don't have enough money in your core TSP account, it automatically pulls money from your mutual fund account into the core, and then you're on the hook for the fees all the way around, and the IFTs count and all of it.
Yep. And they're just going to do it on your behalf.
On your behalf.
Yeah. So if you fall into that realm, you need to read into that.
Yeah, for sure. Okay. Monthly transfer limits. Currently, participants are allowed 2 IFTs in a calendar month. After that, they can only transfer money into the G fund. Any transfer from the TSP core funds to a participant's mutual fund window and vice versa, including a forced transfer that we just talked about, will count toward the existing monthly limit on interfund transfers. Consistent with current rules, a participant may always elect a fund transfer from his or her mutual fund window account to the G fund. So this is where the stuff kind of overlaps a little bit, and it's really not even necessary to get your mind around it. And it's the piece that kind of makes me think that within the window we don't have the IFT restrictions. So it's talking about, you know, if you want to, you can always, as if it's some kind of advantage, you can always move your money from the mutual fund window to the G fund. Why you would do that, I haven't the slightest idea. I mean, you're in the window, you're in cash in the window, right? Why you would ever move that into the G fund, I have no idea.
Well, other than the fact that maybe you've just decided I'm going to be a passive investor and I'm moving it all out, right. Sure. So I quit, right? Yeah. Or I just or we go back to the scenario we just talked about where the G fund is way better, and if I think there's going to be a long time that I'm going to be in cash, I might say to myself, okay, I'm going all the way to the G fund. I'm coming out of the window and into the G fund. I think that's a good thing that they give us that ability, meaning you can always go home. You can always go to G Fund home if you feel like everything is going to crap. And so that's a safety net that
it is.
It's nice that they give you that ability, but what they don't say, they actually do say it, but you have to read between the lines, that let's say I'm distributed between 2 or 3 different mutual funds, and I make this decision. I have to pull out of those mutual funds into my money market. Yep. I'm going to pay the fees, right? I'm going to pay the fees to do that.
To sell all the funds.
Yep. And whatever, repercussions from that, right? To get to the money market, then I'm going to have to go to G. It's not like I can just push a button, all that goes to G. Right. I got to move it all back to money market and then money market back to G. Right. And it does actually say that. It just doesn't say explicitly that you're on the hook for whatever fees that means.
All those fees,
Because they don't know which one you're going to be in. There's 5,000 mutual funds.
Right. Yeah. I mean, I have no reason to believe this is true, but I really hope somewhere in this 5,000 are inverse mutual funds. Meaning when the market's going down, if you're in those funds, now,
very helpful.
They're risky, just like inverse ETFs are risky because generally the market goes down really fast for a short amount of time.
You have to be watching it like a hawk.
Yeah, you do.
Because you can lose way more.
Yeah, you can get crushed in those funds.
Yeah. But it's also an opportunity to make money when the market's going down.
100%.
Yeah.
Okay. Of course, we have to have an acknowledgement of risk. That was on the summary slide. That was setting us up for this acknowledgement of risk. I can't remember what FERSA stands for, but it requires any participant who elects to invest in any investment fund or option other than government securities investment fund to sign an acknowledgement. So you have to basically sign a waiver that says you understand that there's risk and that participants are not protected by the government against any loss on such investments. You're not protected by the government on losses in the GSF funds either. I fund it's I don't know what the point of this is, but and that a return of such investment is not guaranteed by the government. Great. The board is proposing to treat the mutual fund window as an investment option for purposes of this requirement. Right, because up here it defines it as an investment option. So they're doing everything they can to tell you they are not on the hook if you lose money in the mutual fund window. Yeah, which is fine. They're not on the hook if you lose money in the C fund.
Right. Well, but there's a language in FRSA. That's the Federal Employees Retirement something like Act. I can't. Yeah, it's the one that says the rules for all of this, and so in there's a thing that says you got to sign something.
Yeah.
And so we got to sign something that says, So you're going to sign something that says, I'm not holding you liable.
Yeah. I wonder if they're going to make us do a wet signature.
I know.
Right? That wouldn't surprise me.
That would be hilarious. No, what's going to be better is if you have to fax it in.
Yeah, right.
Wet signature and fax it in.
Yeah. You wonder why you retire as early as possible.
I lost my train of thought, which happens all the time. That's why I'm able to put the camera on you.
Oh, bro.
For me, the takeaway is the government's definitely putting themselves in a position where, and I think this is reasonable. I don't like it. Okay, if you have, and I know this is going to piss people off, but I do it all the time, so it's my job on the show. If you got lucky enough to just buy and hold and made your way to $1 million,
Yep.
right? Because the market's been good to you.
Yep.
God bless you. I'm happy for you. I really am. That's not a negative thing, but it was, it was luck, right? You didn't.
You were in when the market went up.
Yeah, and that's okay. It is what it is. But what I see is that, so that's not an educated investor normally, right? And so now I've got $1 million, but I still got 10 more years. I'm going to do 35 or 40 years, whatever it is, right? And I put, $500,000 into the mutual fund window or whatever. I make very bad decisions because I'm not educated. And I lose half my retirement. And I go sue the federal government because you gave me the opportunity to lose my retirement.
Sure.
And if people say, well, that would never happen, I know nobody's saying that if you work for the government because, McDonald's got sued years ago because somebody spilled hot coffee on their leg. That's how it works.
Yeah.
So I get it, right? They're trying to limit liability to the government, and that is the way it works, but it sucks because it puts us in a position where I won't say it sucks. What I say is it just makes it, it's putting more hurdles in the way for us to take advantage of this ability to outperform the core funds.
Right.
And that's what we want to do. We want to get into this window and outperform the core funds. I want to beat the C fund. That would be your goal.
I would have no problem signing whatever they wanted me to sign.
If you could put everything in.
And just don't have any rules.
Right. Yeah, exactly. Or, take a class.
Right, whatever.
Take a class online, and if you can answer all these questions, boom, you're good.
You're good. Yeah. No, it's not how it's going to
happen.
Okay. So here's a couple of comments that we got in Facebook the last time, or one of the times we put up either the last article about this thing or I think it was probably within the last week or two when the register came out. So here are examples of what you guys think about the Federal Register, right? I don't need access to thousands of funds. I'm happy with 5 TSP funds. What I need is more IFTs, at least 4 a month, and the removal of the noon rule. Is there any website that I can go to utter my opinion about changes coming in TSP? Yes, there is, and that's the next slide with the points of contact and how to do it. Right? Amen. I would like to see an option for access to small cap value and emerging markets, but would give it all up for a second. Give it all up in a second for a couple more moves and no noon rule. Okay, so the last one, right? The fees aren't much lower, if at all, compared to private companies with almost no restrictions nowadays. Competition and technology has brought them all to near or at zero. So two things here. This last one, because Alliott is the company that is facilitating our ability to invest in the window, it's not the same as like Fidelity and BlackRock and that. Those are finance companies. So this comment isn't really, it's not directed to what it's really about. These two though, they're both saying the same thing, right? Yes, I'd like this, I'd like that, but what I really want is more IFTs and the noon rule to go away. Same thing here, more IFTs and the noon rule to go away, and I'm in that camp 100%. So here's the addresses.
Screenshot this.
Yeah, screenshot this. This is the portal. As you would expect, they don't really want your comments, so it's really not that user-friendly. You go to that, hit that link. You search in the search bar at the top for mutual fund window. It'll come up. It'll give you a form, and you put in your questions or your comments. Yeah. So, I mean, I don't need a pre-written form. I'd rather not have it. I'd rather have it be longhand, and I just put in my comments. And my comments, hopefully, like all you guys, is going to be, this is all great. Really appreciate the mutual fund window. I'll sign whatever I need to sign, but 3 things. Don't just only allow me to put 25% in there. If I want to put, it's my money, let me do what I want with it. If I want to invest 100% of my money in the mutual fund window, I understand there's risks. I understand there's fees. But if I want to do it, let me do it with my money. It's my money. Number 2, take away the noon rule. And number 3, take away the IFT, the IFT rule.
Yeah,
that's it for me.
I don't think they're going to take it away. I think actually you've mentioned this before. A better part of this, so let's say we're not going to give more FTs. Okay, give it to me in a 30-day rolling window and not in a calendar month.
Sure, that
right?
would help.
Because then I can make it match more to what the market's doing, as opposed to some arbitrary, the 31st is when you've got to, it starts over again.
Or
right?
or let me pay a fee. If now we're in the realm of fees.
Yeah, I'll give you $28.75
for every IFT extra. Right? That would be awesome.
That's actually a better idea, right?
Yep.
Make it a fee, and I'll pay it to do an IFT.
Yeah.
And because that is what, the restriction of the IFTs, that's where it came from, was people were doing so many IFTs, and that racks up the fees, and they can't keep it cheap, and I got it. Okay, give me 2 free,
right?
And I'll pay after that.
I'll pay after that.
So these are the kind of comments you can put in there, and you I mean, honestly, it does matter. I mean, if there's enough volume, I think people would be very surprised, people on the other side of this, if, hundreds or thousands, hopefully, of us comment this, it would get people's attention. I don't know if it'll change anything, but it will get their attention.
Right. So definitely, when you guys are all on Facebook, post it to the other groups, the other Facebook pages and groups, and make sure everybody knows that the register is open for comment.
Yeah.
And
hey, share this video.
Yeah.
So we don't tend to put our videos in other people's groups because we just feel like it's a little weird, but they don't ever care if it happens to make it over there. And there's some groups that talk about the TSP, and we're trying to be the leaders in education for TSP. I mean, I hope that's what you guys take away from all this. We put all this energy in this. I mean, we're giving this part away free. The whole point is we want to educate people. Yeah. Now, our whole paid service is more about, okay, we do have to charge a fee if you're going to look over our shoulder and look at all this analysis that we're going to do. I mean, we can't do that, but we're trying to educate people. And we don't hear anyone else talking about this mutual fund window to this extent. So if you want to, be a good buddy, share it with your friends, because they're not going to get this information from anywhere else. And that's why we're putting it out.
Okay. That's it for the mutual fund window for today. I'm sure we'll come back to it.
Oh, there's more to come. This is for today.
That's it for today. All right. So if you guys remember number 2, so coming back to current day and the stock market, it's been a wild ride since January. So if you're in the stock funds, the market's down depending on whether you look at the S&P 500 or the NASDAQ or the Dow Jones or the CS&I funds, everything's down. So I'm still in the stock funds. I'm getting nervous, and what should I do? So here's the thing. The first question you got to answer, and we've talked about this before, in sort of the methodology about how do you create your plan, right? You have to ask yourself why you're still in the stock funds, right? Are you there for a reason, right? If you're a buy and hold investor on purpose, this downturn is meaningless to you. You've already acknowledged that the market goes up and down. You are satisfied that the amounts that you put in every payday are going to buy shares cheaper, which is true, and your overall account is going to go down and up as the market goes up and down. So if you're a buy and hold person, I don't know I can't imagine why you would be getting wound up that the market's going down.
Get on with your day.
You have acknowledged that as your plan. That is your plan, right?
Right.
Okay. If you're a seasonal strategy person, you've bought into, or you've looked at the different seasonal strategies. You've made a decision that this is the seasonal strategy I'm going to buy. The market goes up and down, right? The seasonal strategies are based on historical, what happens over seasonal patterns historically. And there's a gazillion different seasonal patterns, and you've picked the one that maybe you picked it because it did the best last year, maybe the best in the last 3 years. For whatever reason, you picked the seasonal strategy you did. That's your plan. It shouldn't surprise you that when the market goes down, if you pick the wrong plan, your account is lower. Or maybe you think, screw it. I'm 5 years into my career. Plenty of time for the market to catch up and recover, whatever. So you should be in the stock funds for a reason. The bottom line is there's a reason that you're there. Okay. Why are you nervous? If you're there for a reason, you're not nervous. It's a plan. It's part of the plan, right? So do you have a plan? Probably not if you're nervous about it. Does your plan entail lines in the sand, guidelines that will tell you when you're off track? can you identify like support levels that if it goes below this, I know if it goes below this, I'm out until it gets back above that line. Like, do you have those lines? Is that part of your plan? And then what should I do? So the first thing is you go back to question 1. Why are you still there? Why are you there? Not why you're still there. Why are you there at all? Why are you in the stock funds? You got to create a plan. Some people aren't going to like this. Create a plan based around the market, right? The market doesn't care about you, your goals, your dreams, your vision, how you think the world should be. Why would you base your plan for the market around you? I never understood that. I'm when the market goes up 20%, I'm going to do this. I can't understand how the mentality of I'm going to base my plan around me, but the market is what is happening. I mean, you have to base your plan around what the market does, because that's what we're talking about. I just don't get it. I don't get it. All right. So whatever it is, you got your plan, stick to your plan, because at the end of the day, nobody's plan is 100% and nobody's plan is 0%. So stick with the one you picked.
And the big takeaway, I think, from this is if you're nervous, if you're in a position where you just are, beside yourself that all this is going on, it's probably because you didn't have a plan or you don't trust your plan.
Yeah.
Right? You either don't have a plan at all or you don't really have confidence in your plan. And so, although we don't think you should be nervous, because if you have a plan, you shouldn't be nervous. I can see some cases where you would have a plan, but you feel nervous because you're not confident in it, right? And that's where you just have to get more confident in your plan. The way you do that is you get more educated, right? You learn, you fine tune your plan.
Yep.
And so that's a more active approach, and it's definitely putting you in control instead of
and putting the onus on you to learn it and know what you're seeing.
Yeah.
Right. Okay. So kind of in staying with this idea of what should I do? And this idea that if you want to know what we're doing on the member side of this is the kind of the analysis that we do every week for paid members. So the bonus chart is going to be the S&P 500 is our C fund 8-month daily. There are a million things we can talk about on this chart, but this is the C fund since the top here in January. Okay. So the very beginning of January was the top of the market. So first things first, the red line, okay, this red line is a 50-day moving average line. So even just on a 6-month chart, and it extends back a lot further, you can see that almost every time the market comes down, does a little dip, hits the 50-day moving average line, and bounces higher. Okay? When it doesn't, when it breaks that 50-day moving average line, it tends to get support at the 100-day line. Okay? So in normal times, right, you use the 50-day and the 100-day, you're expecting them to be support. Okay, so if, for example, up here, if you were following our alerts, you got out, it was on this day actually, you got out because there's a big difference in price between the 50-day and the 100-day. Back here, over here, there's very little difference, right? The lines are really close together. So there's no point in getting out at the 50-day when you're expecting support at the 100-day, and there's a very small distance between the two, right? So that's why when people say, well, I'm getting out because it broke below the 50-day moving average. Well, yeah, but how close is the next support level, right? So now, where are we? January 6th, the market rolls over pretty hard. We get a little rebound, and we break below the 50-day moving average line. Market keeps going down, does not find support at the 100-day line. That hasn't happened since the COVID low. If you don't know that, you're sort of missing the point. If you don't know the major support levels, then you don't know where your line in the sand is, and not your personal one, the market's line.
Right. And back to what I said earlier about, the difference between what we do publicly and all the education stuff that we put out and what we do on the paid membership side is the difference is if I just don't have time to track all this stuff, well, that's what Jerry's doing right here. So when our members look at our newsletter each week,
Yep.
they can, that's their analysis. They don't have to go out and do all the research to do this. It's right in front of you. And then Jerry talks us through it and we go, okay. And then I can, I might have a little different line in the sand and I can do that, but I've got all this analysis at my fingertips to be able to make those decisions. So it's like, we call it validation, right? Yep. When you look over someone's shoulder, it's like when the teacher in math class does it, but you still got to learn you have to still understand how to do it, right? A big math problem. It's kind of the same way, right? Jerry's doing the math problem for you. You get to look over the shoulder and say, okay, what's really going on? Oh, okay. Yeah, I missed that. I got it, right?
Yeah, exactly. Okay. So that's the moving average lines, right? So the next thing really is this short-term Elliott wave count, okay? So we had a top here in January. We got a 1, 2, 3, 4. So this may be, right? Friday was a huge up day. So this could be the 4. We get a 5 down here, ideally to like 4,200. And the next piece, the next big recovery rally is going to be critical. Because if it hits resistance up here at the 100-day moving average line and rolls and goes lower, we're in trouble. If we can't get above the moving average lines, and we can't get above these core, right, 45, 50-ish area, we're going much lower if we can't get above those areas. Okay, so the last thing, these dotted lines here, the relative strength index. Okay, if you look at in the first line, so when the relative strength index crossed above 50, so this is at 50, the dotted line in the middle of the relative strength index is at 50. On this day, when the market got above that 50 line, that was the breakout day right there, and it moved higher. The stochastic had turned up, the MACD had already turned up, and everything is in line, and we get that breakout day. So that's an example of when you would get back in, right? When slow stochastic is turning up, MACD is turning up, and we've crossed up through that 50 line on relative strength. So what happens on the other side? We got a breakdown through 50. We get the MACD crossing negative, and we get the stochastic crossing down. That all happened on January 6th. And that's the day we went to the G Fund. That 50% relative strength line crossover is really important. So how does that apply to today? Huge move on Friday. Biggest move of the year so far, right? C-Fund's up 2.43% on Friday. Awesome. Does that mean the bottom is in place? Who knows? But the relative strength isn't even close to the 50 line yet. The stochastic is turning up. The MACD hasn't really turned up yet. You get the histogram, the blue behind those two lines. The histogram ticked up on Friday. But on the whole, the technical indicators have not confirmed this big price move. And the volume on Friday was less than the last several days of down volume. So I wouldn't be buying into this just yet, is the bottom line. And even if you do, if you do decide to buy into it right here, you're still looking at resistance up here at the 100-day moving average line. So how much higher can you get before you hit that resistance and it potentially rolls over? So those are all the things to think about. But that crossover of the relative strength line, either positive or negative, is a really, really good indicator. Okay. So TSP fund charts, 2-year weekly chart of the C fund. It's pretty clear. Last week, or the week before last now, I guess, the first time we broke down through that 20-week exponential moving average since we've been above it here, after the initial COVID recovery. So things are clearly different now than they were before. Until we get back above that line, if you're just looking at TSP on a weekly basis, until we get back above this level right here, which is basically 45.50, and or this 20-week exponential moving average line, there's no reason to be in the C fund, unless and until we get down to the next level of support. So here's this first support line, right? This is the next support level, 3,600, right? We should find support here because we had a bunch of support there at 3,600, and then we broke through and moved higher. So if we lose this level here, which is basically 4,300, if we get a close down here, below 4,200, we're probably coming down here to 3,600, and that's the next time I'd be looking to buy into it. But that's the next support level. It doesn't mean it's going to happen in a straight line, but that would be the next major support level. And obviously on a weekly basis, the technical indicators are still pointing down. S fund, it's even easier than the C fund. You got this unhappy face, right? Inverse to the smiley face. You don't want to be long. You don't want to be you're on the wrong side of the market if you're in the stock funds when you have a frowny face. We came down, did a consolidation, hit resistance right there at the 20-week moving average line, and resistance, held and pushed prices down lower. Until we get back above that 20-week exponential moving average line, no reason to be in the S fund. And the S fund, the support level was 2,100. We've been talking about it for months. All right. There was the support level. We broke through it. We're now in no man's land. The next support level is right here. So maybe 1,700. The one after that, you could argue, here, certainly this top right here. So 1,700, if it breaks through 1,700, you're down to 1,500. They're all guidelines. They're just guidelines for when you could look at getting back in. Because at this point, the only reason that you're in the S fund is because you, like we said on the other slides, you have a reason, right? If you're trading like we are, the actively managing your funds, there is no reason to be in the S fund. I fund, same kind of thing. It's not as pulled down as far as the S fund because the I fund isn't as exposed to tech as the S fund is. But we got the same kind of frowny face pattern there, right? And we've been talking about this for a long time. That 75 level was broke this week. So at this point, until the I fund gets back above 75 at a minimum, there's no reason to be in the I fund if you are actively managing. And the I fund, again, you're talking about support down here at 62.50. And the technical indicators are still pointing down. And we had a huge volume negative week this week on the I fund. And so what that also tells you is that what for the first few weeks of January was primarily growth, high-tech contraction, it seems to be spilling over now into value because the I fund was down a pretty good bit this week, and the I fund is lesser exposed to tech than the other two funds. So it tells you that the The problem in tech and growth stocks is spreading to value stocks. F fund, really not too much to talk about. We got lower highs since all the way back here in 2020. We broke below this support level a couple of weeks ago. So the F fund is in trouble. And if you've been watching the show at all or the media at all, the F fund is directly attached to interest rates. And as interest rates go up, the F fund goes down. So no reason to think that the F fund is going up anytime soon, because the Fed has told us it's not going to. Okay.
Questions?
We did a lot on that show, I'd say.
We got it in there, though. Just right at an hour.
Is it really?
Yeah.
All right.
So we're going to close it out. All right,
Awesome.
guys, if you liked what you heard, please share it with your friends. If you want to ask us questions based on what you heard, you can always put it in the comment section wherever you found the video. You can also email us at info@growmytsp.com.
Yep. Awesome.
All right, guys. Hope you have a great week, and we'll see you in the mutual fund window.
Out of here. Mutual phone window.